So let's do some more tax stuff. So here's the situation. Let me fix this formatting a little. Okay. On February 2nd, Roxy purchases 10 shares of stock from her father for $8,600. So there's different tax rules when you buy something from a related party. A related party is mother, father, siblings. Not all people related to you. If it's like a third cousin, that's not considered a related party, but I think first cousin is. So this situation, the father buys $11,000 of stock. That's his cost basis. So your father buys $11,000 of stock. He sells it to you for $8,600. So he lost money, right? Your father had a loss of $2,400, but you cannot claim that loss. He can't claim the loss because you're a related party. He just has to eat the loss. If he sold the stock in open market, yeah, of course he could claim the loss. Now, if you sell the stock for $6,900, you can claim a loss of $1,700. You paid $8,600 and you sold it for $6,900, but his original cost basis of $11,000 is gone. Like, you can't use his cost basis, because if you did the $11,000 and you sold it for $6,900, you'd have a $4,100 loss. It just wants, they're trying to get people away from doing things. Hey, Kansas City accountability. Right back at ain't cheating. Right back cheating. How's it going? Thanks for joining. I've been talking about tax stuff. It's a little more boring than my usual topics. But I'm trying to take this test. It's called the enrolled agent exam. Actually, I don't even want to like do taxes for a living. I just want to learn the material. Right back ain't cheating. That's it. So I figure when I talk about this stuff, it helps me remember it better. Yeah, it's good to know these things. And especially there's something I'm going to tell you in a little bit that helped me a few years ago when I sold property. But this is for any, it's not just for stock. They're trying to, you could do a lot of shady things with taxes. So they're trying to avoid that. Like, for instance, if you bought land, like $1 million of land, you can sell that land to your best friend for $1, and then you take $1 million loss, right? I mean, that makes sense, but that's why it's, when you sell something to a related party, it cancels it out. You cannot claim it. So any type of asset like artwork, it's the same deal. So here's another situation: related party sales. This is land, but it's paid in installments. This is a popular way deals go through, because a lot of times people can't afford the entire payment, so they pay in installments. So Lorne sells land to his daughter, Mindy. The sale price, he sells it for $25,000. And Lorne, he profited $10,000 because he bought it for $15,000. He sold it for $25,000. So Lorne's profit is $10K. Mindy agrees to pay in 5 installments of $5,000. So Lorne is going to sell it to Mindy for $25K. So Mindy says, okay, $5K a year, 5 years. But there's a lot of nuanced questions, so you have to understand these things because this could happen in real life. So say, for instance, that's a situation. A year later, Mindy decides she no longer wants the land. She did buy it from her father, but now she no longer wants it. And she sells the land to an unrelated person. So now how do you treat the sale from how do you treat the sale, Lorne sale for his daughter? Well, Lorne, he must report the entire profit of 10,000 on the sale. So when you sell to a related party, if you sell at a profit, you have to report the profit. But if you sell at a loss, you can't report the loss, which kind of makes sense because then you could do like real shady stuff with your taxes. You can just sell it for like $1, and then you get this big tax break, and then I'll give you I'll give you 10 grand. Just pretend I sold it to you for $1. So Lorne must report the entire $10,000 profit of the sale, even though he may not receive all the installment payments, because Mindy only made a couple of installment payments. Then she sold the land. The installment sale is disallowed on the related party because the property was disposed of during the 2-year holding period. So the installment sale method is disallowed on the related property. Okay. That's a little confusing even when I'm reading it. So let's just move on to the next one. I'm not going to try to explain it. I understand what it's saying, but okay, abandoned stocks. Happy 4th of July, everybody. Okay, so to abandon a worthless security, a taxpayer must permanently surrender all rights to it and receive no consideration, no money for it. They have to report the worthless securities on Form 8949 and indicate the deduction by writing the word worthless. So they actually have to write worthless on Form 8949. So your CPA would do this. Leandro owns 500 shares of Crossroad Corporation stock. The company files bankruptcy. So what happens if you own stock in a company and they go bankrupt or the stock goes down a lot, you can get a big write-off, right? So in this situation, you find out on December 20th that this company filed bankruptcy. So instead of, sometimes it could take years for like the ticker to go away. Or remember when Hertz filed bankruptcy, and it actually went up the stock price. So instead of waiting for the stock to go to zero or the stock to get delisted, you can just write it off, the entire investment. So he takes a loss on his 2024 return. So it doesn't mention what he invested. It doesn't matter how much he invested. He could have invested 10K into the stock, and then and he gets a write-off of $10,000. You guys know what that means, a write-off. If he had a gain, say you had a gain on a stock sale. Say it was on like Microsoft. You bought 10,000 Microsoft and it went to 20,000 and you sold it. So you have a gain of $10,000. So you have to pay taxes on all gains. Yes, say most people are owed 15% if they. Let me open my file. Yeah, long-term capital gains are either 0, 15, or 20%. What about Webull stock? So if you buy stock and you hold it for at least a year, then and you sell it and you profit, then you pay long-term capital gains. If you sell it exactly after 1 year, you still have to pay ordinary taxes. It has to be after a year. So exactly a year doesn't work. It has to be more than a year. So if you own a stock for like 20 years, that's fine. Most people are going to pay 15% of taxes, depending on like how much money you generated from long-term capital gains. I mean, if you sold millions and millions of dollars of stock, you pay the higher rate, but most people aren't at this level. Most people pay 15%. Taxes, people don't think about taxes, but like that's about 25% up to 33%. So 1/4 to 1/3 of your money goes to taxes sometimes, and people don't even think about it. So in this example, if you never sell stock, you never have to pay taxes. Well, you have to pay tax on dividends, but so say you had a gain of $10,000 from Microsoft stock, you have to pay taxes on all gains. Anytime you profit on anything, you have to pay taxes. So say you're at that 15% level, so you pay $1,500 in taxes when your CPA does your taxes. But in this case, if you were able to write off this $10,000 stock, then it would net against it. So you would not have to pay the $1,500. So that's where it's beneficial, stuff like this. Here's something I used once, and I'm glad my CPA told me, but I should have known this. Bill Clinton passed into law the this tax break. So in 1997, he put this into law where if you sell your primary residence and at a profit, do you guys know that? So if you buy a house for $200,000, you have to hold it and say it triples in price. Let's say doubles. If you buy a house $200,000 and it goes to $400,000, then you profit $200,000. But you have to pay $30,000 of taxes. That sucks, right? So I'm at 15%. But this new thing Clinton voted on was your first $250,000 is tax free. So if you sell, it's only for your primary residence. It's not for rentals. So if you buy a property and rent it out, it's not for that. It's only your primary residence. So $250,000 tax free. And if you're married, you get $500,000 tax free. That's pretty nice, right? That's like, if your tax rate, that's like going to be almost $100,000. So I'll go through the example. So that's the basic situation, but this example is, you need to know, this is like the basic information you need to know to do this. Okay. So Paula retired and has lived in Miami for many years. So in January, she purchased a new home. And then 2 weeks later, she sold her old home for a $40,000 gain. So in January 2024, she sold her house at a $40,000 profit. Why do you think Bill put that into effect, the House rule? I think it's great. It's just that just trying to find ways to encourage people to, well, it encourages people to buy real estate and live in it rather than rent. I mean, there's a lot of things it does, but that's one thing that jumps out at me. So in this example, in January 20, Paula bought a home in Tampa. Also in January 2024, she sold her Miami home. So she had a home already in Miami when she bought this house in Tampa. So she sold her Miami home for $40,000. There's a couple of rules in order to get this tax break. In order, because if you, in my example, if you sold a home for $200,000 profit, in order to not pay taxes, there's two things have to happen. In the past 5 years, you live in the home too. Live in the home. So you have to live in the home too the past 5 years. And then you have to own the home to the past 5 years. So just those two things have to happen. If you like for instance, say you bought the house and you lived in 2019 in the house, right? Full time. And then you got a job and you moved to another state and you rented that house. So you rented it from 2020 2025. You would not get this break. You have to, in the past 5 years, you have to live in the house 2 of the last 5 years. It doesn't have to be consecutive, 24 consecutive months. For example, you could live in a house in 2020 and you rent it for 2021. You could live it in 2022, 2023 you rent, in 2024 you rent. So in the past 5 years, if this is a situation, you're fine. Chris, what's up? This was good. I didn't know this, and in my CPA, we were looking for a CPA, and he mentioned this because we just moved from New York to California, and he told us about this. And it was good because we'd actually live in our apartment in Manhattan because we were in California. We were renting it, but we just did cash the 2 years in the first 2 years. So in the past 5 years, we rented 3 years, but the 2 years before that, we lived there, so we were okay. It saved us a lot of money. I mean, it saved us like almost $100,000. So this is the situation. In January 2024, this woman, Paula, bought a new home in Tampa. She owned a home in Miami also for many years, and she sold it and had a $40,000 profit from that home. So the Miami home, the one she sold, she had owned and lived in Miami home for 4 years leading up to the sale. So she was good with the 2-year rule. She can exclude the gain on the sale of the Miami home. So she doesn't have to pay taxes on the $40,000 gain. Normally she would have to pay, I guess, I hate this keyboard. It's so sticky. It takes so long to move it. So if this law wasn't in place, she would have to spend $6,000 in taxes. So it's a small gain, but it's still nice to save $6,000. But she moves to Tampa. Remember, she bought a home in Tampa, but she hates Tampa. So she ends up selling her home in Tampa like right away, like after living there less than a year. In October 2024, she sells the Tampa home. And she actually profits $6,000 on that sale, but she has to pay taxes on it. The sale was not due to okay, because Paula had excluded gain on the sale of another home within the 2-year period, she can. So within the past 2 years, if you sell a home and get the tax deduction, you can't do it again for at least another 2 years. So she has to pay taxes on the $6,000 profit on Tampa. Well, also, she didn't live in the Tampa home that long, less than a year. She has to live there at least 2 years anyway. Keep on keeping on. Shadow Guy, what's up? So here's another person who sold their home. I know this stuff may seem boring for some, but it's helping me. And I know it's helping me because when I did the questions at the end of the chapter, the last chapter, I got them all right. I think by talking about it helps me. So like I said before, if you sell, it has to be a sale at a profit. If you sell something at a loss, the IRS doesn't care. You don't have to pay tax anyway. It's only if you sell at a profit. So the ownership test and use test. So there could be a situation where you didn't own the home. Like for instance, if you live with your parents, say you were 25 years old and you lived in the same house for 25 years, your parents owned it. So obviously you have the 2 years of living because you lived there your whole life. So you have that down pat, but you don't own the home. Even if you buy it from your parents and even if the home is worth like $1 million and you buy it for 100,000, you cannot get this deduction because you didn't own the home for at least 2 years. And like I said, it doesn't have to be consecutive years as long as it's 730 days in the past 5 years. I guess that's it. I thought I had more on this related party sales. I should have more set up on my uh, okay, this is more about the ownership test. Here's a situation where this person cannot get the tax benefit. Let's um, okay, so Parker resides in Phoenix as his main residence. He has a lake. He has a cottage. He owns a little property in Lake Tahoe, but he only uses it during the summer. So he wants to sell his cottage, his vacation home, for $220,000. But he cannot exclude this gain from his income tax because he didn't live there 2 of the last 5 years. I'm about to sell a house in California, but no tax breaks for me, I think, because I haven't lived there. Yeah, that's what happens. So I guess another reason Clinton put this passed this bill is because he wants people, the way you build an economy, the way you build like, if you think about the US, it's kind of like a business. Same thing with a state. It's you run a state or a country the same way you run a business. So in order for the economy to flourish, you want people to buy homes in that area, right? Because it puts money into that town. But you also want people to live there, right? Because if they live there, what do? They eat. So go to restaurants, go to the supermarket. They buy supplies because they want to fix their home. They use doctors, so they want people to live there as well, not just buy and rent. So that's why it's a little stringent. If you like, when I was in Mexico and I couldn't buy a property there because they said you have to live there to buy it, which makes sense if you think about it. Because if you're running a city, you have to think like this. You have to get people in your city, and it's okay to have investors just buy real estate in your city and rent it out. It's not a bad thing, because it's still it's better than having just real estate sitting there and nobody buying it, which some towns it is like that, where you can't even sell a property. You can't even give it away because people don't want to live there. So you have to entice people. So this bill, that bill passed, it entices people to live somewhere and to buy real estate somewhere, because if they do buy real estate and they live there, then they get a big tax break, and that's the main source of net worth for a lot of people, their home. A lot of people became millionaires because of their home, and by giving these kind of incentives, it encourages people to buy and live in a certain area. Let's see, example. I mean, for personal reasons, I think this stuff is good, but it will help you for investing purposes also. So Mickey owns a duplex and resides in one unit. Unit A. Mickey lives in Unit A. She bought the property 10 years ago. So in 2015, she bought it. I like when I study, I like to write it out like this. The visual helps me remember it better. Okay, sure. During the year, Mickey sells the duplex for 340,000. Okay, so sell 340K, gain of 140K. Okay, I gotta read it better. Okay, Mickey owns a duplex and resides in one unit, while her brother Harry. Um, her brother Harry lives in another unit for free. So she lets her brother live in the unit for free. She bought the property 10 years ago for $200,000. I guess she bought the entire property for $200,000. She bought the property $200,000, 2015. During the year, Mickey sells the duplex for $340,000, a gain of $140,000. Since only half the duplex counts as our main home, so she lived in Unit A. Her brother lives in Unit B, but she can't get the deduction for the whole property because the 200K she paid was for both units, but she's only able to get the tax deduction for one unit because she only lived in one of the units. Since only half the duplex counts as her home, Mickey must exclude only half the gain. So the gain of so she has to pay taxes. So she has a gain of $140,000 when she sold the entire property. But she has to pay taxes on half of it, on $15,000. The other half she doesn't have to pay any taxes on. So she has to pay 10,500 in taxes, which is good information for her to know. Hopefully her CPA told her this. Uh he would say, Mickey, just so you know, you're gonna owe 10,500 on this property. So make sure you don't spend the $340,000. Make sure you have at least 10,500 to pay taxes. I have family in Canada. There was a scandal in Vancouver where lots of homes were bought by wealthy Chinese Russian investors who may have even left the homes vacant. Yeah, I've heard stories like that. I mean, there could be worse things in the world than buying homes and leaving them vacant, but it's not ideal. Because if you buy a lot of real estate in a town and you don't do anything with it, uh, sure, the person who owns the property is happy because they got paid, but the economy doesn't flourish if I mean, could like think of the extreme situation. That's how I like to think of things. I hate this keyboard. It's so ridiculous. So freaking slow. Okay. Okay. Okay, so let's say there's a street, right? And you live in home one, and these other 9 homes, let's just pretend like a wealthy Chinese person bought these 9 homes as an investment and just didn't do anything with it. So you're the only one living on this block. So it's just it doesn't help the community to have nobody there. It doesn't help at all. Sure, the guy who bought it is still paying taxes. Hopefully, he's paying his real estate taxes. Sounds like he probably is. He has a lot of money, but it doesn't go. It's not doing anything for the community to have no one there. I mean, it's better than nobody ever buying the house they're vacant houses and they just people just do damage to them because no one cares about it. But it's not that much better to just leave homes vacant. It's not what you want. You want to be filled with people, even renters. That's how you build a community. That's how you fund a town. Is you need people there who can work and who can also provide buy things. So let's see. Okay. Mabel bought a house in 2019 after living there for 10 months. She moved in with her boyfriend and left her house vacant. So she bought a house in 2019.
Or 90. Yeah. You have 20 to get the help us. Thank you. I'm a bit sick.
Okay. So in 2019, Mabel bought a house. So after living there for 10 months, so she lived there for 10 months and then she moved in with her boyfriend. No, oh, she bought a house in 2019. So after living there 10 months, she moved out of the house. And then she moved maybe across the town. So now she lives with a boyfriend. She moved in with a boyfriend. Then they broke up and Mabel moved back to her house in 2022. She lived there for an additional 16 months until she sold it in September 1st, 2024. So that is good because she did 10 plus 10 months plus 16 months. So she lived there for at least 2 years, 24 months. And she owned the house for at least 2 of the last 5 years as well. so she can get this tax deduction. Briella, who's 25 and married. Well, this is the one I talked about. His situation where she lived in the house but didn't own it. So this girl lived in the house she grew up in for 25 years. And then last year in January 2024, she purchased the home from her parents because her parents wanted to retire and get a smaller place. And Briella remained in the house until the end of the year and sold it. But she doesn't meet the criteria of owning and living in the house for 24 months. So she can't get this tax deduction. Why are you obsessed nowadays with taxes? Well, I've been explaining it. I'm taking this test, the enrolled agent exam, and this it's an IRS gives it the IRS provides a test, and this is besides a CPA. This is the only other way you can do taxes and charge money for it. It's just easier for me to remember the information if I talk about it rather than just studying it. And I've always been into taxes. I think it's important to know this stuff. So if you bought a house for $300,000, and you sold it for $500,000, and say you only lived there for a year and a half, you would have to pay $30,000 in taxes. But wouldn't it be good to know that you would just hold off selling it for a few more months so you can get the deduction and not pay $30,000? What hamburgers? Why hamburgers? We could talk about hamburgers. Wait, did they talk about hamburgers in this question? Alana is a college professor. Okay, let's go through these examples and then we can talk about something else. Okay, Alana is a college professor who teaches history. She purchases and moves into her home. Six 2022. On 6/1/2023, she moves. She moves to Germany. On August 1st, 2024, she returns to the U.S. August 2024, she returns to the U.S. from her sabbatical, and 1 month later, on 9/1/2024, she sells her home. So let's see. So she lived in a home for 12 months here, from 6/1/2022 to 6/1/2023. On August 1st, she returns to the U.S. and then a month later, she sells her house. So she hasn't been living there for 2 years, 24 months, so she cannot get the deduction, even though she owned the home for 2 years. She didn't live there, so she's not entitled to the Section 121 exclusion. Sophie lived and owned a house in Miami for many years, from 2015 to 2019. So for 4 years. She got a job overseas and relocated to Australia. Her daughter moves into her house and lives there rent free until it's sold in November 2024. So 12/1/19 to 11. It's so stupid. 11. I hate when I see stuff like this. There's no 11/31/2024. That's not a real date. There's only 30 days in November. I'm going to email the company. This is hard to find. I'm just going to email a screenshot. Page 193. Okay. Wait. She moves to Miami and lives there rent free until eventually sold November 30th. Sophie can. Wait, that doesn't make sense. She lived there from 2015 to 2019. Oh, I see. Because if she sold it in 2024, she hasn't lived there at all the past 5 years. Okay. Juanita bought her home in February 2022. Each year, Juanita leaves her home for a 2 month vacation in Ecuador. Because she hasn't. No, I think she could, right? She owned and lived in the home for 2 years, so she can't exclude it. Her vacations are considered brief. Okay. You guys don't like this tax stuff? Yeah. Okay. Let's talk about. I was following the World Series of Poker. I don't know if you guys do that. What stocks do you guys think we can do a DCF on? Yeah. What stocks do you want to look at? Any ideas? Looking at LB. That's not Lyondell Basel. LB. Mm. I don't know. What is LB? I don't see a ticker for LB. Land Bridge? Is that what you're talking about? Land Bridge? It's too common of a LB is too common, so it brought up a lot of other. Is it a okay? It's a Get Oil Company. Okay, yeah, I haven't seen this before. Let's look at this. 5.1 billion, $66. Land's Bridge. I heard of Land's End. Wow, big growth in future, up to 196 million. But I think it's been going up a lot. The price, based on the little information I have. Oh, maybe not. I thought it would have been going up a lot. Well, it's only a year old, the stock. 27. So it went up quite a bit though, I guess. 27.84, it's come down. So it's been, the Bears have been winning the past month, but it ran up a lot. It ran up to 84. Let's see. Simply Wall Street's at 58. That's really close to me. That's almost identical to me. I'm at 58. Eight analysts at $80. So they say it's undervalued. It looks pretty good. The financials look really good. Lots of growth. 51 million, 130 million. And they have positive free cash flow every time period. What about Honest? Honest Teas? They probably have a lot of debt. 375 million of debt. Little cash. Their equity 600 million, debt of 400 million. So not terrible. Not much insider activity. It's almost all owned by institutions. Horizon Kinetics, is it a SPAC? What is Horizon Kinetics? Okay, so it's similar to a SPAC. It was created via a reverse merger. Horizon Kinetics had a reverse merger with Scott's Liquid Gold. It was previously a private entity. Lots of funny business going on. Morgan Stanley owns a lot of the company. I guess this was the predecessor company. It was before it turned into Land Bridge. It was Horizons Kinetics. That sounds like a healthcare company, Kinetics. They had 7 employees. Now they have 4 employees. Is this a holding company? Do they just invest? Land Bridge. Is this like Berkshire Hathaway? They just invest in other companies? Land Bridge is a holding company. It is a holding company. Born in Delaware. Its parent companies in China. It operates logistics, oil and gas, real estate, tourism. I would short this stock. This seems a bit questionable. Lots of funny accounting going on. Yeah, because they only have 4 employees, so they obviously are not doing anything. You can't operate a business with 4 employees unless you're a, small business, but they're not a small business, 5 billion market cap. It's interesting. I do like looking at new companies. Yeah, I'll be right back. Land Bridge. I didn't get this for behind the curtains. Behind the curtains? What other stock? H Honest Tea. Honest Company. 567. 515. Okay, so free cash flow looks pretty weak. It's going up to 39 million by 2025. That's 20 million. it's a bit they did have negative free cash flow in the trailing 12 months. It was positive before that, but really, really in the red in 2022. So really, can they get back up to positive free cash flow? That's so I'm at 7.34 a share. Let's see what it's been trading at. 18. So pretty much at IPO was the peak, or right after IPO, and then it just came down since then. Got really low in 2023, $1.16. It did run up to 8, which is kind of close to my target. And it has come down from 8. So it seems not a safe stock. Simply Wall Street is at $1.80. Let's see the analysts. There's no analysts looking at the stock. That's generally not a good sign. So revenue looks pretty good. 200 million up to 389 million. So it's a modest growth. But they've always had negative earnings at every time frame. But when your revenue is low, it takes time to get the profitability. So they probably need to hit like 600 million revenue in order to be profitable. They are debt free, so that's good. They don't pay a dividend. They have a female CEO. And then look at all this in the past year. Look at these sells. Everybody's selling the stock. Every insider. Nobody's buying it. Not one buy. That's a pretty big red flag. I could handle a couple people selling it, but everybody is selling it. So if they don't want it, you wonder why should you want it? Okay, a lot of people own the stock. This looks like it could be a good what's it called? Like short-term trade. I don't want to say like a swing trade or day trade, but like I don't think you'd want to hold this that long. Not more than a year. But the thing is, it would have been great when it was under $3. Because it was a real discount. Under $2. But even if you did buy it, say you bought it for $1.86. That's April 2023. So you'd have to wait 7 months, and you're still under $2. So after 7 months, then you would have saw some movement up, but you would have had to wait at least 2 years to get a pretty good return. But you can't hold it that long because it only stayed above $7 for like 2 months, and then it came down. So I don't like stocks like that where you gotta like really time it. They manufacture tea. They sell diapers and wipes, skin and personal care. I thought it was a tea company, the Honest Company. It offers baby care products. I mean, it's a good business model. There's demand. It's important. The Honest Company. Are they honest? Well, Sprouts. That's another. It's I like going there to supermarket. It's pretty pricey. 16 billion 162. Financials look really good. 519 million of free cash by 2027. I'm trying to. So C is really overvalued. No matter what I do, it's overvalued. I guess I could lower the whack a little. But yeah, it seems pretty overvalued. Simply Wall Street's not saying that. They're at 187. 13 analysts at 183. So maybe I'm wrong. But the financials look really good. Look at the free cash flow is always positive. Earnings are always positive and going up. It almost seems too perfect, right? Yeah, everything looks really good. Revenue went from 2.8 to 8. So lots of growth. So they've been doing acquisitions. You can't really grow like that organically. They're debt free now. So that's good. They got rid of their debt. They probably paid off debt when they went public. No dividend. They have a male CEO. Once again, everybody, even that might be more than the other company. Sprouts, everybody's selling their stock. And they sold it at 180, 160, 140, 130, 198. And it's 160 now. So they could have waited. But they want to get paid. They've probably been working for 10, 15 years, this company. They want to get paid. It's almost all owned by institutions. Yeah, this is lots of employees. That's growing, 35,000. I think this is a good long-term hold. I think in short term, you probably you might not make money, but I think if you hold it for at least a year or two, you should do well. They have 400 stores. It's like a Whole Foods type business. I'd compare them to Whole Foods. They were founded 23 years ago. Looks pretty good. Everything looks pretty stable. Any other stocks that LB Sprouts? You guys want to talk more about taxes? So another good thing about being married is that, remember that $250,000 write-off? Well, it's 500,000 if you're married. You have to file a joint return. I think if you're married filing separately, I don't think you get it if you're married filing separately. You have to file a joint return. And like, say for instance, you bought a house like 10 years ago, right? And then your wife moved in last year. You could still qualify for this as long as either spouse meets the ownership test. But you both have to live there though for 2 years. Okay. Neither spouse has excluded income in the past 2 years. But if only one qualifies for the 2-year rule, then you only get $250,000. But you both have to live there for at least 2 years. But in terms of owning it, only one has to own it for 2 years. I could see like a woman, like a really hot young woman. She marries this rich guy, and he has like this $3 million home. And she lives there for like I was doing that. So the rich guy bought the house in like he bought the house in 2000, and she lives there for like 18 months. And she's like, I hate this house. It's so small and cramped. You got to buy a $10 million home. So she kind of like yeah, so she complains, oh, this house sucks, this $3 million home. I want the across the street, there's this $10 million home. And he says to her, all you have to do is wait another 6 months because you lived here 18 months. You have to live here for at least 24 months, and then I get a big deduction and save 250,000, which is what, 37,500. 37,500. So he's like, just wait 6 months, and then I could claim both of us for the deduction, and I'd save 37,500 more. And she's like, no, no, I can't live in this house. It's too embarrassing. We have to move right now. So he just accepts it because he just wants her to be happy. So he moves to a $10 million home. I'm just coming up with this silly scenario. So when I take the test, I remember me saying this. So I don't forget that in order for both people in order to get 250,000 for each person, they both have to live there for 2 years, even though only one has to own it for 2 years. Way, since you ask. Is that United Way? Waystar. 6.839. $6.8. It looks good. They're forecasted to grow a lot in the future, up to 343 million. Okay. So I'm at $44. They're trading at 39. So a 12% discount. Way, way, way. Way, way, way. So why is their future expected to grow so much? And they didn't have that much free cash flow in the past. Revenue looks really good. That's also expected to grow a lot. Simply Wall Street's at 51. I'm at 44. Let's see what the analysts say. The analysts are at 48, which is pretty close to me. I'm at 44. So this is another new stock. In mid-2024, it started trading. And the peak was in March of this year at 43, which is pretty much what my evaluation is. So it's come down from the peak. So it looks like it belonged up here at 42, 43. Waystar. But that's just how it is. When a stock goes up, more people are likely to sell it. Like if you think about it, like in a logical sense, that's the price. So right now it's trading at 39. So say it's about 50-50 in terms of so when every time it goes up, so say it goes from 39 to 43. So now instead of it being 50-50 buy sell, now you have 55% are looking to sell it and 45% looking to buy it. And let's say it goes to 47. So now you have 60% of investors looking to sell it. Because as it gets higher and higher, it's not as good as a value anymore. Like if somebody was eyeing this at 39 and it goes to 52, then probably not going to buy it, or they're less likely to buy it. And if you own it, you're much more likely to sell it as it goes up in price. So as it keeps going up to 57, because there's going to be a point when everybody's looking to sell it if it gets too high. Alberto, if you have some time, Scott, check out CMIG. So that's why generally a stock peaks and it usually has resistance points. And like this doesn't have much history though, but so that's like the resistance point right now, 43. And then there's a big sell-off, people taking in their gains who bought it down here. And then it trades down. And then when it gets too low, like if it goes from 76 down to 39, see more and more people are likely to buy it. CEMIG. Did you mean CEMG? I don't know. I don't see anything for CEMIG. Is that that's not a ticker because it's 5 digits. Is that the name of a company? CEMIG. Oh, it's not an American company. CMIG is Brazilian. It's a Brazilian electric company. So is this one on top? Oh, CIG. CIG. CI Games? Yeah. I don't think this is the company you're looking at, right? CIG. No, that's what country is that? Is that a Kazaki company? CIG. No. I don't see anything. Oh, it's CI Games. It's a Polish company. Oh, it is the first one I was. It's the Brazilian energy company. Okay, so a Brazilian company, Campania Energetica. I think I might have looked at this once. It's Brazilian. Brazilian stocks always trade at a huge discount because the stock can't get that high because of the country risk. So it has like a ceiling. Even if the fundamentals, the financials situation. So that was 13 reais. It's getting back. But it's going to be usually discounted. Okay, 36 billion, $11. Oh wait. Damn it. It's 2.6 billion. It's not as discounted as I thought it would be. 12% dividend. That's a big dividend, 12%. So they pay quarterly, I think. Yeah, high growth, high dividend, pretty stable. Yeah, it's the real is the concern. The thing about Brazil is their economy is good enough for us to invest in them. There's a lot of Brazilian stocks. One of my best stocks is Brazilian. Like you'll pretty much never see an Argentinian or a Chilean company. Like some countries, you'll just almost never see stocks from that country. It's just the risk is too high. But Brazil is one of the mid companies where it's stable enough for us to invest in, but they have to offer this massive dividend for us to do it, and that's why. But if you really like Brazil, I mean, Vale. Is a great company. They're one of the big three miners. They kind of with their two counterparts, they control nickel, iron ore, copper. Yeah, New Holdings. Wait, are you the person I did a live stream with? That we live streamed? Because there was a Brazilian guy I live streamed on his channel. Was that you? Well, Netflix has gone up so much, so New Holdings is not my best, but 221%. So it's almost my best, 221%. I wish I didn't sell any New Holdings. I sold 20,000 of New Holdings to buy Lumen. And look at Lumen, down 50%. No, I'm Spanish. Okay. Banco Bradesco is a holding company that owns 3% of Vale. Yeah. And one of the jobs I had, we used to lend to banks, and I was responsible lending to Brazilian and Turkish banks. So I'm pretty familiar with a lot of Brazilian banks because we lent to God, it was like 15 years ago. Um, well, Banco do Brazil, that was we lent to them. Banco Bradesco, a Banco Santander, yeah, Itaú, Unibanco, Bradesco. Banco, we used to call it Banco Bradesco, but you're saying it's yeah, we used to call it. Well, I used to call it Banco Bradesco. It looks like Banco Bradesco. Look, Banco Bradesco. But you're saying Bradespar? Well, that's news to me. Bradespar is a Brazilian holding company headquartered in Sao Paulo. It was established by Banco Bradesco. It looks like it's the same company. Bradespar is a holding controlled by Bradesco. It holds 3% of LA. Okay, well, you learn something new every day. Thanks for the lesson. It seems pretty good. Brazilian stocks are pretty good investment. They're a little risky, but I think they're similar to Chinese stocks. Like we'll invest in Chinese companies, but we usually want a really nice dividend or we want a pretty big discount. So Real, 13 Real. That was the peak in 2012. You can see the ups and downs are not like a US stock. US stocks, there's a big surge in 2020, well, a drop in 2020, then a surge in 2021. And then with US stocks, you see a 2001 and then in 2008. This is a little different. Oh yeah, no problem. So I mean this is a big tax is huge because like I said, it could be a third a third of your money goes to taxes, which makes a big difference. When I invest, I think of taxes. I don't want to hold the stock less than a year because I don't want to pay ordinary income taxes. I want to pay long-term capital gains. You have to hold it for a year. So Mavis and Santiago have lived together for a decade, but only got married a year ago. They sell the house they co-owned for 10 years. They're both listed as co-owners on the deed, even though they were not married. They purchased the house at 210, sold it for 785, a profit of 575. They could claim the $500,000 exclusion for married couples. Even if they chose to file separate returns, each one will be eligible for $250,000 because they both own the home and used it as a regular primary residence. So you don't have to be married. You can, if you have a brother or sister and you say you buy a home together, you put $200,000 each, 200,000 each. So if you buy it for $400,000 a house, you and your sibling, and as long as you live there 2 years, and say you sell it for double, you sell it for 800,000. Both of you can claim the $250,000 waiver. So you both get $200,000. Okay, if you buy a home with your sibling, a $400,000 home with your sibling, right? And then you sell it for this much. How much money would each of you get after taxes? So, say John and Jim, whatever your name is, you both put up $200,000 each, and you bought a house for $400,000. Say 3 years later, you sold the house for $800,000. How much money would each of you have after selling the house after taxes? So pretend you're John and your brother Jim. You and your brother split a house together, and you sell the house 3 years later for double, exactly double. How much would you have in your bank? How much cash would you have left over? Forget about all those fees, like with the agent. I'm just assuming that's all part of it, and you paid the fees, and that's you had 800,000 left over after you paid all the fees. So how much would each of you have after both of you guys paid taxes? Because you both get that deduction. Well, you both get 250 as a deduction. You don't even need to use it because the profit was 400,000. So is anybody with me? So okay, I'll write it here so you understand what I'm saying. Okay, you and your brother buy a house for 400K, 200K each. So you both split it. 3 years. 3 years later. 3 years later, you sell the house for $800K. Okay. How much would you have? Would you have in cash after the sale? So you and your brother, I'll put you, your brother. You want to buy a house together. So you find a $400,000 house, you split it, and 3 years later you sell it for 800,000. Everything you split. And we know the deduction, right? We know that if you sell your primary residence, you can deduct up to $250,000 each. So you get the $500,000 deduction. So how much would you have in cash after the sale? So after taxes and everything, how much would you have in your bank account? Is anybody with me, or are you confused? So how much would you have personally as taxes? So once you sell the home, I know someone has to get it. So I'll review it again. Well, we know about you got a $250,000 allowance if you sell your primary home for a profit. So if you bought your home for $100,000, 3 years later you sold it for $200,000, 100K, 200K. The profit is $100,000, and you pay no taxes on that profit because of Bill Clinton. He passed a law saying you don't have to pay the first $250,000 of profit on your but you have to live in the home for at least 2 years. You have to own it for at least 2 years, which you and your brother did. But let me know in the comments if you're not clear. I could explain it. 3 years later, you sell the house for $800,000. You lived in it the whole time. Now, when you sell something at a profit, there's a tax implication. So how much would you personally have in cash after the sale? I can come back to it later. But I know somebody's going to get it. And we know the rule, the $250,000 rule. Because if you buy a house for $100K, and sell for $200K, like say it was a stock. If you buy a stock for $100K, and 3 years later you sell for $200K, you profit $100,000. You definitely have to pay taxes on a stock sale. Most people pay 15%. That's long-term capital gains. You have to pay the IRS $15,000 because you profited $100,000 on that stock sale. So pretty much anything you sell at a profit, you have to pay to the IRS. So did anybody know what it is? It's I think 1041. That's the in 97, Bill Clinton passed through the Taxpayer Relief Act. So he's providing relief to taxpayer. Section 1041 dictates that transfers of property between spouses, including those incidents of divorce, tax free. Which date? The Taxpayer Relief Act of 1997. So here's what we're talking about. So when Clinton passed through the Relief Act of 97, it did a few things. One thing, it lowered the tax rate, long-term capital gains, from 28% to 20%. Lower top long-term capital gains from 28 to 20%. So this 20% used to be 28%. Now it's 20%. And this is what we're talking about right now. A permanent exclusion of capital gains up to $500,000 for married couples and $250,000 for single people on the sale of personal residence. But you have to live in a home for at least 2 of the last 5 years. There's that's a pretty big one, because a lot of people own a home, and So that's a big tax deduction that he passed through. Then you have the estate and gift tax relief. So he increased the estate exemption from 600,000 to 1 million. So that's when you leave your estate. Say you have your estate, which is property, your investments. If you have $800,000 in your estate, in the past that was taxed, but now $1 million tax free. And there's other things too. I should learn about this too. He adjusted the IRAs, allowed parents to save for college expenses with tax-free growth. Penalty-free IRA withdrawals. So you could take money out of your IRA for qualified education. So if you have money in an IRA, you usually get hit with a penalty if you take it out, but you could take it out if it's for educational purposes. He also passed through a child tax credit. So just for having children under 17, you get a credit. So if you're making like below a certain amount of money, like below $50,000 a year, you get a credit of $400. Now it's $500 for each child under 17. But if you make a lot of money, you don't get this credit. Only if you're low income. So somebody has to get this answer. So if you and your brother want to buy a home together and you find a $400,000 home, so you both split it $200,000 each. You both live in the house for 3 years. And then somebody wants to buy it for $800,000 and you sell it. How much money would you have in cash after the sale, after taxes? How much would you personally have? Because now you know about the $250,000 credit. Both of you would receive that allowance. So what are they? It's called okay, it's a exclusion of capital gains. I don't know if that's clearer, but for your personal residence, $250,000 is excluded from capital gains. I'll show you. So say you buy a house in 2022. For $150,000. Say you're single. You sell in 2025. Say you sell it for $100,000. Your tax rate Okay. So example A. Okay, example B, you buy a house in 2022, the year, for 150K. You sell it for 150K. So your profit is 0. Tax rate is 15%, and you pay nothing in taxes because you didn't profit at all. So you end up with $150,000 after the sale. Example C, you buy a house for 150,000, you sell it for 200,000. So what's your profit? 50,000. And your tax rate is $7,500. Oh, I mean, 7,500 in taxes. So how much money is left over after the sale, after taxes? 192,500. It's 200,000 minus taxes. Are you with me on this? But we know that you can profit up to $250,000 and not pay any taxes. So if you profit, so if you buy a home for $150,000, you can sell it for $400,000. That means you profited $250,000 from the sale, and you pay 0 in taxes because the first $250,000 is a credit. But once you go over 250, say you sold it for $500,000, then you have to pay taxes on only $100,000. Okay. Well, no one's really responding, so I just want to make sure this is sticking, making sense. But does this chart make sense? This is like all the different scenarios. If you buy a home for 150K, and this is what you sell it for, this is your profit, and this is your taxes. Now, if you're married, then you each get $250,000. So you can actually you can sell a house for a $500,000 profit, still pay no taxes. Okay, I'll see you, Lilo. I guess it's a little confusing. Trying to explain this over but okay. I'll see you guys later. I'll probably do a stream tomorrow. Talk more about tax stuff. Okay, thanks a lot. Talk to you later. Happy 4th.